Simon Pearse, the CEO of Marriott, now joins me on the desk, taking a look at how you can preserve your capital and, of course, some of the big issues that we could face going forward, and one of them being inflation and the fact that we could actually see a rate cut despite the fact that inflation, of course, is rising. Simon, welcome to the program. What is your sense with the current economic environment when we have a heated debate with regards to a possible rate cut to try and boost economic growth, and that could also just affect people's savings, the way that we view various asset classes? How does one extrapolate what you should do in a very volatile market?
Well, I think inflation is on the up. It's certainly been on the up this year to date. And there are inflationary pressures, there's no doubt. I think with the weakening of the currency, as we've seen recently, all the imported goods, which is over 30% of our economy, will become more expensive. So I think there are ongoing inflationary pressures. And usually inflation can only be addressed by the Reserve Bank using monetary policy, raising interest rates. So there must be a pressure on them to raise interest rates. However, the other side of the coin is the consumer, who's no doubt under pressure, over-indebted, undersaved. And I think a lot of the electricity hikes and the benefits they had from the cut in interest rates has begun to catch up. So I think the consumer is very much under pressure. And that would really put the Reserve Bank in a position where they don't want to raise interest rates, because that'll hurt the consumer. So I think the million-dollar question is, what will they do with interest rates? However, we're probably at the bottom of the interest rate cycle, and I think the longer term is more than likely an increase in interest rates. Exactly when, we don't know.
Well, let's look at how then one does invest in a very volatile scenario, as I mentioned earlier. What would you be doing? What would you be advising? Would you take the safer stocks when looking at equities? How much would you actually put into cash and bonds? Is it difficult to allocate funds right now? And I suppose you also have to look at the current needs of the people, your clients. Do they need money imminently, or is it for the long term?
Yes, of course, one needs to look at an investor's particular situation. However, for an investor who is saving for the future and trying to build a capital base, equity exposure is always important, because your growth in income comes from the equities, and hence your capital value appreciation. I think the sort of equities one would look at is the companies that are operating in the environment where the consumer has to spend money. The food producers, the retailers like the Mr. Prices, the telecommunications companies, and interesting telecommunications companies like Vodacom, MTN. They're on relatively high dividend yields, so you're getting a good dividend in the order of 5.5%, 6%. One would look at those sort of businesses, secure income streams, the grocery stores, as I said, the pharmaceutical companies, places where people have to spend their money, a secure dividend stream. On the income front, where one might be looking at higher income yields, accumulating capital through reinvesting that income, we would err away from the property and fixed interest bonds, where you're only getting yields of 8%, and you can almost get those yields from corporate debt, inflation-linked bonds, preference shares, even bank deposits. Not quite, but almost. And there's no risk of capital loss in the corporate debt or deposit type areas. Whereas fixed interest bonds, property, we feel longer term real returns are not there, so there is certainly capital risk in that space.